Happy Wednesday, October 30th, Halloween Eve. Welcome to Chart This with Dave Keller. I am your host, Dave Keller, coming to you from a lovely, beautifully cold and rainy Redmond, Washington. Thanks for joining me every weekday after the close as we make sense of these markets together using the language of technical analysis today in what has turned out to be kind of a turnaround Wednesday with a nice gap lower, at least a trade lower out of the open, a nice rally into the lunchtime hour, and then a nice slow and steady decline, finishing in a position of weakness. Watched during the day today. I was actually doing a number of events and interviews. Had a discussion with Andrew McGowan of Fidelity. Thanks to him and Trey Gerald at Fidelity for a great discussion about technical analysis and active investors. Interviewed Ari Wald of Oppenheimer in a podcast interview, a snippet of which I will share with you in a short while on today's broadcast, talking about one particular group that he thought was important to highlight, but we'll be editing up that interview and sharing it with you hopefully very soon. But as I'm going through these interviews, these webcasts, these discussions, I keep checking on the markets and breadth indicators, which had been fairly constructive in the morning session. By the end of the day, I mean, at best neutral, and at worst, kind of a little worse than neutral. So you certainly saw distribution through the course of the day. A couple pretty big newsworthy events, especially super microcomputer getting dinged by double digits in a big way, certainly weighing on the technology space and some ripple effects of that, I feel like, being felt through the course of the day. Also, some mega cap earnings. We've got Microsoft, Meta to talk about, Apple, Amazon. A lot of companies reporting earnings this week. So let's get to the market recap. Focus on how things played out through the course of the day today. As a reminder, by the way, I can see comments that you're putting in the in whatever comment section you see in front of you, whether you're streaming this live on Facebook, LinkedIn, YouTube, or X. I can see your comments real time if you're watching the live stream. If you're watching the replay, I can certainly see your comments on the YouTube channel for sure. Put your questions in if you're watching it live as we go along, and look to take a question or two. I will not talk about the baseball playoffs, though. Although 3-1 Dodgers so far. We'll see if the Yankees can continue that run. Nice performance last night. That's fair enough. Having said that, the market recap: S&P 500 down 1/3%, closing the day just below 58.14. The Nasdaq Composite down 0.6% to 18,608. And the Dow Industrial Average down about 1/4%. Now, what's interesting is all of these were in the green earlier in the day. And you know, when you're thinking about sort of, general reflections or anecdotes about what sort of sense you're feeling, the market drifting lower, opening stronger, right? Sort of getting that initial bid, but then rolling over into the close really, I think, tells you the general sentiment that we're observing here. It's not particularly overwhelmingly bullish. Now, again, if you're long-term bullish, I mean, arguably, we're really leaning far over our skis here in late October of 2024 after an incredibly bullish year, an incredibly robust uptrend, a fairly consistent bull market phase with limited drawdown. So at some point we need to pull back, right? And the pullbacks we've had so far in 2024 have been relatively painless, right? The biggest one was in July and August. I was just less than 10% down. So it's actually highly unusual to not have a number of pretty decent pullbacks. Even in a bullish year, even overall, if the trend is positive, you need that natural mean reversion. Maybe some of the news flow we received this week with things like super microcomputer, maybe this is part of the catalyst of things starting to rotate. AMD also down about 10% today. Those are bellwether groups in tech and semiconductors. We'll see. Mid caps and small caps, by the way, flat. The S&P 600 small cap index, the best performer of the group, essentially flat from yesterday's close. The VIX continuing to toy with my line in the sand. I have this great strategy of saying, listen, it's pretty easy. VIX over 20 is high volatility. VIX below 20 is low volatility. And then I feel like week in, week out, we're sort of bouncing all around that level. Now, generally speaking, volatility has been more elevated here in the last 6 months than it was in the 6 months prior. And I would say the VIX getting above 20 is usually an important level to watch. Over the last couple of weeks, we've been trading above and below, right around that 20 point. Every day that we remain above a VIX of 20, to me, just means further potential or further chance, a greater probability that we have more deterioration in price action because the markets don't tend to drift higher on elevated volatility, tend to drift higher on lower volatility. They sell off. Volatility is usually a sign of uncertainty, anxiety, and instability, which usually means asset prices are risk assets are going down. So we'll see. For today, we're back above the 20 level with the VIX up about a full point from Tuesday's close. Looking at the interest rate environment, actually a little bit mixed. The long bond yield and the 10-year yield did drift slightly higher, although it was kind of a choppy session for bonds, just like it was for stocks. Bonds actually opened pretty strong along with equities. They were correlated pretty closely together today. The TLT did finish about 1/3% higher, but long bond and the 10-year points did move slightly lower. 10-year yield is just about 4.25%. The long bond yield just below 4.5%. The 5-year point around 4.13. And by the way, one of the things I'm not going to share this clip with you today, but in my conversation with Ari Wald of Oppenheimer just a short while ago, we did talk about interest rates. And I thought his comments about how to think about interest rates as an equity investor, given what we've seen so far and given some expectations going forward, I thought were brilliantly laid out. So I look forward to sharing that interview with you on the Market Misbehavior podcast, hopefully very soon. Dollar index slightly down. The UUP was down just about 0.25%. Commodities also mixed. Mixed is sort of the adjective I've used to describe a little of everything. We're sort of in wait and see mode, I feel like, in a lot of ways. There were companies that did fine with earnings that traded higher and broke out, but a lot of other things that gapped lower and showed quite a bit of deterioration just today. And you're seeing that in the commodity space too, right? Gold was up, silver was down, crude oil prices slightly up, natural gas down. And so even within one area of the market like this, you sort of had a big difference between what was working and what was not working. Keep an eye on crude oil. Crude oil prices obviously have been pretty weak recently. This week has not been particularly strong for crude oil. The energy sector continues to underperform as long as crude oil is going down. Today, popping higher, and you need more of that to, I would argue, justify looking at energy stocks as a particularly interesting place to be, because that's essentially a play on crude oil prices most likely going higher. Bitcoin here in the last 24 hours did threaten all-time highs. We're sort of right at that level. If you look at current levels, look to the left on the chart. I think on yesterday's show, we featured the chart of Bitcoin in our chart review. You can see we're kind of right there. And today we chopped around below that ceiling, sort of that 72 to 74,000 range. Those are the highs to key in on. This is so close, I would say, with Bitcoin to resolving this basing pattern to the upside, meaning we're emerging to a new high. We're showing that buyers are willing to pay more than they have in a long time for a Bitcoin, and we'll see. For now, currently just around 72,000. That's down slightly from yesterday. Ether prices just above 26.50. All right, looking at the 11 S&P sectors, almost 50-50 here. There are 11 sectors, so as close as we can to completely mixed. Communication services, the XLC, that's your top performer. Materials, number 2, the XLB. Both of those are up about 0.6% from Tuesday's close. The financial sector, number 3, up about 0.5%. On the downside, 6 of the 11 S&P sectors finished lower. Technology, the big loser today, down 1.5%. As I mentioned, some of the biggest gaps down, some of the brightest red boxes we'll see on the market carpet come from the technology sector. SMCI, AMD are 2 that we'll look at in a little more detail today. But technology down 1.5%. Utilities, consumer staples down slightly, about 0.2% from yesterday's close. Looking at the advancers, decliners, again, earlier in the day, it was way more advancers than decliners. It was sort of like in that 60-70% range. But then through the course of the day, this more and more evened out. And I love a visualization like this that allows you to assess the change in the advanced decliners over time. And just looking at it in the morning, right out of the open, looking at it midday, looking at it at the end of the day. Even if you just take 3 quick snapshots and just look at how things change, you'll know plenty about the dynamics of the trading day, how things evolve from open to close, what sort of, and then give you an idea of where you want to dig in a little bit further. But again, it's sort of neutral breadth, with almost a 50-50 split between stocks closing higher and stocks closing lower. So no surprise to this host as I look at the Magnificent Seven and Friends, that just like the S&P sector split down the middle, just like advancers, decliners split down the middle, here on the Mag 7 stocks are split down the middle as well. Alphabet, the biggest gainer, up 3%. This was an earnings name yesterday. Nice follow through so far. We'll see if we continue to build momentum above that breakout I would argue Alphabet's now completed an inverted head and shoulders bottoming pattern, with this week pushing above the neckline of that pattern, which is usually the traditional buy signal for that chart pattern. Amazon up 1%. They're up with earnings tomorrow. Microsoft essentially flat for the day. They are reporting earnings just after the close today. We'll check the after-hour session here in a bit, see if there's anything to note. But Meta and Microsoft essentially close to zero, which is usually, which is often very common going into a big earnings release. And arguably, this is it as we look forward to Meta and Microsoft, the AI influence. These are stocks that overall have been obviously in a pretty good run here for quite some time. Do you see additional momentum? And what about forward guidance? Do you get any sort of color on what to expect going forward? Apple, which reports tomorrow, down 1.5%. NVIDIA down, arguably in sympathy with AMD and other tech names. So some of the technology components down the most. All right, well, look at the market carpet here briefly, and then I'm doing to share with you a couple minutes of my interview earlier today with Ari Wald. We were talking about one particular group, an ETF part of the financial sector that I thought was really well described. Gives you a sense of what how Ari looks at the world. If you followed my work over time, as I've interviewed people, I love having Ari on my shows because he's a thoughtful analyst, really knows the market. He's a market historian. I would say he's a technical analyst and a market historian, and for that, I'm very appreciative. So before we get to that, the quick snippet with Ari, just a quick check on the overall conditions. I mean, how bright does Google have to jump off the page for you to recognize that's that's a thing, right? Alphabet up about 3% today. That's after earnings yesterday, after the close. Nice result, nice upside afterwards, and nice completion of that breakout above the neckline of that potential bottoming pattern. I'm also noticing some bright red here in the technology sector with Apple, NVIDIA, and then a bunch of other things. Apple and NVIDIA were down, but relative to some others in the sector, not down much at all, right? Applied Materials, Micron, Intel, these are a bunch of semiconductor stocks down quite a bit. AMD down about 11%, which is really the story in terms of S&P 500 members, I would argue. SMCI not on this page, but certainly not a particularly strong day. We'll look at that chart here in a moment. What else would I say? Generally speaking, otherwise, kind of a mixed bag. I mean, you can see things are kind of neutral more than anything, but you can immediately see some of the earnings names like Eli Lilly, PayPal, both gapping lower. Visa actually gapping higher. Didn't get above 290, which is sort of that resistance level we've been talking about on a closing basis. Traded right up to it today, but not quite getting above there. So I'll leave it to you to review the market carpet, this heat map visualization in a little more detail. But big takeaways are the strong update for Alphabet after earnings. A lot of red in the technology sector. And again, the challenge there is this has been one of the leading sectors in October, sort of feeling like it was emerging in a new leadership role. A day like today feels like it is doing the opposite of that. And then kind of mixed opportunities elsewhere, a little green, little red, and plenty of things to look for. All right, I'm going to share with you a snippet of my interview with Ari Wald. Ari Wald's the technical analyst at Oppenheimer based in New York. I've known Ari for a number of years. He's a really, just a sharp analyst, knows the markets and knows market history. And that's why I love how his discussions and his outlooks are really affected by and informed by his study of what's worked and what has not worked previously. Now, I'm going to warn you, the last time I did this on the show, I torpedoed my own audio and had to fix it. So I'm hoping that doesn't happen. But if so, hang with me as I fix it afterwards. Here's a brief conversation with Ari Wald of Oppenheimer. Finish off our discussion, just talk about some areas of opportunity. You've highlighted a couple here in a recent note. The first one is capital markets and the sector spiders, the S&P spiders. There's a bunch of these ETFs, the KBE for banks, KRE for regional banks, KIE for insurance, and you're highlighting KCE capital markets. Talk to us about the technical implications, the justification for optimism on a chart like this.
Love this industry. We went back. We do weekly reports. Since August of 2022, we've written on capital markets favorably 18 times in 18 of those weekly reports, which just goes so letting our winners run on here. And we do think there's additional upside. What we found and what was so notable to us is here we're looking at a very long-term monthly chart of it going back to even 2005. We're looking at that capital market spider KCE that you noted because it's equally weighted as well. So it's not just being driven by Goldman Sachs and Morgan Stanley. This is capturing a broader swath of the industry, some mid and small cap stocks as well. And what we found is that for in a prior decade, this tracked banks pretty well. And a lot of that downturn you saw from 05 into 2015, it was very correlated to interest rates. And then something changed in that 2015-2020 period. Interest rates kept moving lower. They made significant new lows during the COVID period. Banks made new relative lows. Capital markets did not make a new relative low. They started to carve out this base, and you see it even in that it's a 4-year average, really capturing that long-term trend. And it started stair-stepping higher. It became a leadership area even ahead of the bull market turn in 2022. It was showing relative strength ahead of the upturn in October 2022. And then as the market turned, this group really started to break out. It started to break out from levels from even before the great financial crisis, and it's turning on a relative basis. It turned versus the equal-weighted S&P. Here we're showing now it's turning versus the cap-weighted S&P. And we see a large structural shift going on. So as we think about high momentum and wanting to be staying true to our methodology, this is high momentum. It's one of the top ranking industries. It's broadly strong. I could probably rattle off 10, 15, 20 names in this industry that are just moving from the lower left to the upper right. And those are the charts telling a story. That's what we love to see when it's not just being driven by one or two stocks.
Yeah. Yeah, to your point, KC equal weighted, and so there are a lot of individual names in that ETF key holdings that just continue to go higher. There's some beautiful charts, I think, underneath the hood there. So that was a snippet of my conversation with Ari Wald of Oppenheimer. Again, that was part of our Market Misbehavior podcast. We'll be releasing that interview hopefully later today, maybe tomorrow, as I get things edited up and ready to share with you. But again, that was sort of toward the end of our conversation after we talked a lot about Ari's process, a lot of historical analysis, thinking about how, we look at momentum and how we measure trend and anticipating when there are opportunities based on new emerging trends. And that led us to capital markets as one ETF. That was KCE that we were talking about there as a potential new leadership area of the market. So interesting today to see financials. One of the better areas after my conversation with Ari Wald. Again, that'll be part of the Market Misbehavior podcast, hopefully coming your way very soon. All right, let's continue on with today's show and our chart review. The S&P 500 chart is what we're looking at here. And as you may note, we remain above trendline support. That blue trend line is taking the low from early August, the low from early September, and connects very well with the lows that we've experienced really over the last week or so. And what's interesting about a trend line like this is what I was taught is you draw the trend line from the first 2 points and then you kind of extend it. And then every time you retest that trend line, it kind of further validates that, yes, that was a great sort of visual representation of this trend. And it also gives a lot more weight. The more you test it successfully, that break, which is going to come at some point, becomes even more meaningful because that means more and more this is a representation of the trend, which means it's more and more significant when that trend is finally broken. So we'll see how the rest of this week plays out. But again, over the last 5 or 6 sessions, we've literally been testing that trend line support that we drew, over a month ago as we were, bouncing off of that early September low. So for now, I would say even with the choppiness and the volatile session today, the S&P remains in a primary uptrend, higher highs and higher lows. Trend lines like this, lines in the sand, as we've talked about, sort of help you differentiate sort of that garden variety natural pullback that happens in the push and pull of any sort of trend versus something that's more significant, more of a reversal in trend. Not seeing enough of that yet on the S&P as we remain above trend line support as the momentum overall remains fairly constructive. Now, as we've talked about here on recent episodes, one of the realities of this market, though, is that the breadth conditions are actually a little weaker than normal. And particularly, you're seeing breadth divergences really play out over the last couple weeks. Going into mid-October, the S&P is making new all-time highs, threatening that 5,900 level. And we can see that some of the breadth indicators that we have talked about, percent of stocks above their 50-day, actually sloping downwards. Bullish percent index, which is a breadth indicator based on point and figure charts, also trending lower. So higher highs in October on weaker momentum. What's happened since that bearish divergence, by the way, is you've seen further deterioration. As of today's close, we're just below 55% of S&P stocks above their 50-day moving average, which means about 30% of the S&P 500 members were above their 50-day moving average in late September, and now at the end of October are no longer above their 50-day. So while the S&P and the Nasdaq remain in a clear primary uptrend, a lot of individual stocks, about a third of the S&P, arguably are no longer in a primary uptrend, or certainly at a point where you'd have to question that and determine that a little more closely. I think that tells you something. The bullish percent index on the S&P 500 has come down and dipped below the 70% line. And that, for me, when we go above 70% for a while and then come back down, that is often a sign of a bull market that's reached its exhaustion point. The reason why I can set that threshold a lot higher is because point and figure charts are all about trend, right? So a bullish point and figure pattern means we've broken out and we're in an uptrend. To generate a sell signal from a point and figure chart, it's not just right at the top. The price actually has to move down quite a bit. So the fact that so many stocks are actually registering sell signals means they're not like potentially topping. They're already broken down to the point that their point and figure chart is registering a sell signal. So two concerning divergences, I would say, breadth-wise, in the month of October, and what's happening since that divergence is kind of classic behavior for a bull market top, sort of the end of a bull market run. So we'll continue to observe that here going forward. Also, about a week and a half ago on my YouTube channel, I posted a video on the volume indicator that I follow, particularly called Chaikin Money Flow. This is a way of stringing together daily volume readings to think more about volume as a measure of accumulation and distribution over a period of time, as opposed to just looking at one day's volume and drawing conclusions from that. I was taught, look for what the price does and then glance down to see if that movement is supported by an increase in volume. And excessive volume on a move usually means it's a more important move. Mark Chaikin was able to iterate on that process, or really improve on that way of tracking volume by looking at where the price closes within a daily range and using that as a way to factor in volume. Bigger directional days mean bigger directional volume impact, and a stock that closes in the middle of the range, the volume is not clearly bullish or bearish volume, and so it's more neutral. This indicator that you're seeing at the bottom of the chart of the S&P 500, which is a 2-year chart using daily data, when it's in green, that means there's accumulation, stronger up volume than down volume. Basically, we're in a red period, more distribution, right? More down volume than up volume. And so what you're looking for right now, kind of the plain vanilla signal, would be the Chaikin money flow going below the zero line. You can see the last couple times that happened, it's been pretty good at representing sort of the end of a big impulse move to the upside and the beginning of a decent correction to the downside. But these red arrows highlight what I was talking about in that video. And if you want more color on this, check that out on my YouTube channel. But basically looking at the market moving higher on weaker volume trend. And so that's sort of a bearish volume divergence. We're seeing that in the month of October. And again, we saw that in July of this year before the peak. We saw that in March of this year before the peak. We even saw that in July of last year before that August, September, October sell-off happened. So again, with breadth and volume, I'm not seeing a lot of this is great kind of conclusions from my analysis. I'm seeing a lot of divergences, which, while they don't guarantee a peak, certainly are consistent with major market tops going back. Super microcomputer, certainly probably the name in the news today, down about 33%. If you missed this, and I don't know how you could have, if you watch any sort of financial media, because it was all over the place. Basically, their auditors, fired themselves from auditing the books because of some inconsistencies. They didn't feel comfortable continuing to audit. That's not a great sign, right? When your auditor, opts out of auditing your books. I mean, that's usually not because they feel pretty good about what they're seeing. That usually because they're not particularly comfortable with the type of stuff they were seeing. Now, Super Microcomputer, of course, sort of the poster child for the 2023 bull run. And in the first quarter of 2024, this is a stock that went from around $25, $30 a share up to over $100 a share in less than a quarter, right? In about 2 months. I mean, it was an exceptionally strong rise. And that was after exceptionally strong rises off to the left part of that chart before that significant rally in Q1. From there, though, it has been in a primary downtrend. So if you're owning Super Microcomputer, I think at like $40 a share, right, from a month ago, I think you're ignoring the fact that this has been in a primary downtrend. Look at the chart of Super Microcomputer since that March peak, and you can see a pattern of lower highs. And what happened was we'd sell off a little bit and then be sideways, and we'd test that resistance a number of times before breaking to the downside like we saw here in July. Then we sort of set a new equilibrium price just below $50 a share. Again, we number of times tried to push back above 50, failed, and as of today, we're gapping down 33%, which obviously hurts quite a bit. But I would argue this is sort of the latest downward step within a downward trend that has been in place really since March, April of this year. This is a stock that's been going down. So this is just the latest downtrend. Look at the momentum, by the way, that's been in that bearish range really since March. So overall, I would say, the trend continues to be downwards. Literally, this is I don't know if that's a typo, but if that's true, that is literally the worst chart in the entire large cap universe, according to the stock charts technical ranking. I wouldn't describe that as necessarily bullish. So that's the type of chart I would be avoiding until you see some signs of accumulation. I did show a couple charts on yesterday's show, and I do want to update them just because these are earnings names. I think it's helpful to just sort of see what happened, sort of going into the announcement, what happened afterwards, and see what we can learn from that. So this is what happened going into the announcement yesterday. AMD closing higher, closing back above the 200-day moving average. And what we talked about was, is there enough of an upside catalyst that we continue to hold the 200-day and break above that early October high around 170, 172? That did not happen. The stock gap down over 10% today, which not only means a failed attempt to get above the 200-day moving average, it also puts us below a trend line below the August and September lows. Think of that trend line we had on the chart of the S&P. It's kind of like that trend line was broken on this chart of AMD. So, not a good sign for AMD. There's been a big ripple effect to all the other semiconductor stocks. This is a bellwether group. If you're bullish, I would not be particularly comfortable by stocks like AMD gapping lower on earnings, right? Because what you need are for these stocks to have positive outlooks, positive expectations going into next year. That's how a sustained bull market continues to justify higher and higher valuations, because hopefully the earnings come up, which bring the valuations down. And so higher prices are justified by greater earnings. This just feels like the opposite, where the price is gapping lower on lowered guidance. Alphabet, by the way, nice gap higher. That's a thumbs up. We did close almost 3% higher, which is good. Here's the problem. We opened here above 180. We traded up to around 182, but by the close, we're about $8 lower, right around 174.50. So nice gap higher, not a great end of the day sort of run, as something like Alphabet finished below the open. That on its own is not the end of the world, but this is after Tuesday's session where we finally broke above that inverted head and shoulders bottoming pattern, that break above the neckline above 168. Pretty meaningful. I'm not thrilled with what I'm seeing today, where we're opening higher, gapping higher, but then trading lower. So tomorrow will be interesting to see if you see at least some sign of accumulation. And if we do get further deterioration, that breakout level often will become support. That's a technical concept called polarity, where resistance becomes support and or support becomes resistance. So keep an eye on that level if you do get further deterioration and there's further weakness. A lot of payment processors, Visa, PayPal on the books yesterday. PayPal actually closed above yesterday's open, but today you have what's called a bearish inside day, where you have an up day followed by a down day. Today's range is narrower, so it's actually called a bearish inside day, which is not particularly strong. I'm keeping an eye on that 50-day moving average, which lines up with the early October low around 76. I'm also noting a clear divergence going into the report yesterday. Visa a little bit better. Now, again, it traded above this neckline, which you'd probably call a cup and handle continuation pattern, but we didn't really follow through. It kind of closed right back at that level. So through the remainder of this week, can we get above 290 and stay there? That would be the question to complete an upside follow through on Visa. McDonald's gapping lower last week and trading lower. We've talked about the gap and run pattern, which is a gap higher and then a run higher. So you have a gap higher, then you have additional buyers coming in. That's usually a very bullish sign, because even though we've gapped higher and revalued the stock overnight, you have additional buyers willing to take on additional shares at that elevated price point, that elevated entry point. The opposite of that is what you're seeing here with McDonald's. This has been a primary uptrend into mid-October. You have the gap lower, and now we're actually trading lower. This is the whole E. coli issue with the quarter pounders. That's weighing on McDonald's. Reported earnings yesterday, but really not a lot of upside follow through after that. To the contrary, today closing below the 50-day moving average again. It appears to be a gap and drop, I guess I would call this, right? With the gap lower no real additional accumulation, but to the contrary, seeing distribution as the RSI is pushing just below 40. All right, just a couple charts to finish off, and then I'll take a question or two to wrap today's show. Meta and Microsoft, the two M's in the Magnificent Seven, reporting earnings today after the close. We'll look at the aftermarket trading here in a moment, but I would say with Meta in particular, it's all about 600, right? This is where we opened today. We actually traded a little bit off of that level. That's the high from early October, from mid-October, and now late October. This chart over 600 completes that upside follow through after the breakout in September. If we would fail there, the 50-day moving average 540 is sort of that breakout point, that pivot point from before. I'd want to make sure that that would hold if I'm long a chart like this, just to see what happens next. Microsoft, by the way, again, opening higher, trading lower, which happened with a lot of charts right now. We have broken above that trend line resistance, so I'd want to make sure that holds. On a bullish report, you want to get above 440, which would take us above the September swing high. That would complete or continue that pattern of higher highs and higher lows. Let's look at the two of those very quickly on the aftermarket. Here's Meta. So aftermarket, down slightly. It's still kind of early. It's currently trading right around 590, not too far off the close, about 1/3% lower. So not much of a aftermarket move there. Microsoft trading a little bit higher after hours to around 440. That's the level we talked about. Again, going into tomorrow, a lot of noise in the aftermarket, sort of less liquid, but look to see what happens tomorrow with those charts. Can they get that follow through that represents a continuation of the previous trend? All right, let's see. A lot of great questions coming in here, and I appreciate it. Appreciate it so much. Rich watching on YouTube. Dave, the VIX is at 20 plus. Time to worry or just a cautionary mindset for now? Yeah, really good question. So I would say in terms of the VIX, as we've talked about, 20 is kind of the line in the sand for me. It's not a rule, right? I would never manage a portfolio called the VIX 20 portfolio, and you sell stocks when the VIX is over 20 and you buy them or whatever you would do to bet off that. I don't think it's that effective, but for me, it definitely tells us about the environment and when things change. Generally speaking, VIX above 20 means a volatile environment. And just excess volatility is usually not highly correlated to bull markets. That's more of a bear market phenomenon for volatility to spike. The other observation, I guess, to answer your question is to also remember that the VIX moves in regimes, right? I always talk about volatility regimes. And to show you an example of that, I'll take this chart back about 5 years, right? So this is the VIX on the top half. This is the S&P on the bottom. I'm showing the VIX on a daily closing basis, just for to keep a cleaner chart, so we can look at it. Look at 2021, where the VIX kind of ranged between 15 and kind of 30. Then you have 2022, more of a bearish year, where we range between 20 and 35. Then we have 23. As the year progressed, we sort of got down into the teens, which is where we spent most of certainly the latter half of the year. That continued through mid-2024. And so from July on, I would say the volatility has been elevated. So I would describe it as fairly unusual that over the last 3 months, the S&P is going higher and the VIX, with a lot of noise, is generally trending higher, right? If you look at the 50-day moving average of the S&P and the 50-day moving average of the VIX, they're kind of both going up together. That has happened. That can happen. The relationship, that inverse relationship, is usually more related to shorter term timeframes. But generally speaking, yeah, when I see excess volatility like that, that usually doesn't give me a warm and fuzzy feeling about the sustainability of an uptrend. That tells me more and more likelihood that we're in a distribution phase, maybe a stealth distribution phase that just isn't reflected yet in the chart of the S&P. An example of that would be like November, December of 2021. Look how the VIX spiked up to around 30. That was just during this brief pullback, and we did end up making a new high. But the fact that the VIX was spiking up to that level, I think, indicated that we're probably getting, the increase in volatility spoke to an increase in uncertainty, even as we were still technically within a bull market phase. That's what concerns me about right now, is that we're kind of in that fourth quarter of 21 kind of period. And if you remember what happened after that, we saw all the signs of rotation. So elevated volatility for me is kind of a leading indicator that we could, rotate lower. Now it's all about the line in the sand, the levels below which you have to be a little more concerned. Next question, Rauf, I believe. What about Crocs? Sharply down yesterday. Someone asked about Crocs on the show yesterday. I didn't get to it. That might have been you, and I appreciate if you came back and asked again. Yeah, so Crocs, we talked about earlier, the chart of McDonald's, right? Gapping lower, the gap and drop, right? What you don't want to see when a company reports earnings is a gap lower, right? I mean, ideally, it's a good report, good outlook, good expectations or constructive outlook. And so the stock gaps higher. And ideally, after a gap, you have additional buyers come in. The opposite, and really the concerning and more bearish equivalent of that, is what you're seeing on the chart of Crocs, right? I would say up until yesterday's sessions, this was Tuesday's gap lower, this is today's follow through. You know, as of Monday's session, not a bad chart. I mean, not a great chart, but not horrible, right? And we'd held the 200-day moving average a number of times over the last couple months. I would say that's kind of a constructive pattern, kind of holding that range. But the problem is when we gap lower on earnings, the question is what happens? One of two things is going to happen here. Either we gap lower and investors that were not willing to buy it at 137 all of a sudden see a good company at a discount trading around 112, and they think, great, I'll buy in at 112. And that's that pattern you might see on some charts where it gaps lower, but then you immediately see buyers come in, right? We gap down and then all of a sudden it starts trending higher. And what that means is essentially a bunch of value investors are seeing that gap lower and they're like, thank goodness, I can get Crocs at a deep discount. I'm going to ride it higher. When this happens, you gap down and then trade lower today. That is the opposite. That's where even though the stock has been, you know, it's a fire sale on Crocs, right? It's like a 20% off sale. You still can't get people interested in buying the stock. And that often, again, one day, but it often can speak to larger issues that we're not completely all aware of yet. That might be an issue that will become clear down the road as we look back and wonder why Crocs went lower. I would also say this gap lower takes us below a neckline. If you consider this sort of a head and shoulders top-like pattern, gapping below that 115 level kind of continues or completes that breakdown scenario. So I would say Crocs for me is the type of chart I avoid until you see signs of accumulation. Indicator to use here, something like MACD or PPO, can be really helpful at helping you recognize when a downtrend is no longer maybe a downtrend. Great questions, you guys. Thoughtful questions as always. I really appreciate it. And thanks for joining me here if you're on the live stream, and thanks for making it an active discussion today. If you're watching it on a replay, I appreciate you just as well. All of our previous episodes, great interviews like the one I had with Ari Wald, can be found on our YouTube channel called Market Misbehavior. And for Market Misbehavior, I'm Dave Keller. Remember, it's always a good time to own good charts. Have a great night.